You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 8/17/21. Well, you're going to hear about a real interesting way to effectively be your own bank and cash flow your own projects or finance your own cash flowing projects. It's an interesting concept that I've been aware of for a while and haven't talked to anybody about it recently. So I figured now is as good a time as any. And if you got a question about it, please feel free to send me an email to kl@kerrylutz.com. Well, right now, Jim Oliver is with us. And Jim, you are founder of CreateTailwind, and you've got a lot of other things that you're doing, and we welcome you to the show. So tell us about this infinite banking concept and how you use it to build wealth.
Absolutely. Thank you, Kerry. Thanks for having me on. So what we're doing is we're using a money pool that we build and capitalize in the beginning, and we're using it to go buy cash flowing assets. Now, a lot of people that have heard of infinite banking concept or maybe even read something or watched a video, it's a lot of stuff about how to pay off debts. But we're talking about financial freedom and financial independence. So we're showing people how to go buy cash flowing assets. Could be businesses, and real estate is a business, as you know, Kerry, but the people sometimes don't think of that. They separate the two, but real estate, businesses, and we're showing them how to finance those businesses and use the seller and the bank's money, and sometimes in concert with this concept in this money pool. But as we're doing that, we can create a system that starts to leverage on itself. And over a period of 5 to 7 years, every dollar you're putting in is going to be, you're going to be able to use $1.50 or more to go invest in more cash flowing assets.
Mm-hmm. Interesting. So basically, how much money do you need to start with to do one of these deals?
People start with a really wide range. I mean, some people start with as little as 20 grand a year into something like this, and people put millions of dollars a year in. We just had one young real estate investor who's done really well, who's doing $175,000 a month from his escrow. So he was just putting $175,000 a month of escrow dollars in a commercial bank, having it sit there, letting the commercial bank take that money and go use it to make money. Now he's putting it in his own money pool bank and then using it until the escrow's due.
So what kind of administrative costs are there on these on this type of account?
So there really isn't any administrative cost, because what we do is we're using a special insurance contract, an insurance contract like corporations and banks use. Banks have something called BOLI, bank-owned life insurance. Corporations have something called COLI, corporate-owned life insurance, and they're designed for high cash value. And instead of like something like a New York Life or Northwestern would sell, where you're protecting your family and the death benefit, right? So we're using this insurance contract, and you need that insurance contract because that's the tax shelter that we're putting money into, and we can keep it under the definition, the the IRS code 7702 definition, so that money grows tax-free. We have access to it tax-free. And at some point in time, Kerry, when we graduate from this world, there's a death benefit that'll be passed on tax-free as well. So we build this insurance contract. Well, the insurance company pays us to design this insurance contract and implement it for you. So you never pay our company $1, the insurance company pays. And then wherever you start, 20,000, 2 million, wherever you start, you always grow it, because as you're buying these cash flowing assets, money starts to flow back to you and it faster than what you can put into the policy. So you need more policies. And now all of a sudden your assets are building up the cash value, not your income or your time.
I see. All right. So I see it's got certain benefits and the ability to buy additional coverage from periodically. How does that work?
Well, as long as you qualify, you can keep buying, and you qualify two ways. You qualify from a health standpoint and you qualify from a financial standpoint. But let's say you can't qualify from a health standpoint. Mm-hmm. Well, one of the cool things about this is you can buy insurance on anybody that you have is called insurable interest. So if you and I were in business together, I could buy an insurance contract on you with your permission and that you agree, but I would own it. I would be the beneficiary. You would just be the insured. So I control the cash, everything else. So all of your employees, you could insure. I mean, not all of your employees, but your key employees, your business partners, et cetera. And on employees, you can even put together some type of non-qualified deferred compensation to have golden handcuffs to keep your employees.
Mm-hmm. All right. So it's got a lot of applications to it.
Absolutely.
Yeah. So what average Joe six-pack, how much of a policy is he generally going to buy?
Don't just survive, thrive. The Financial Survival Network.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
It's funny because we find that probably the average is $50,000 to $100,000 a year flowing into the policy. And because they're going to put it to work, it's not like I'm putting $100,000 into something a year and then I'm waiting for 20 years to utilize that money. I'm putting that money to work sometimes within a month of capitalizing that policy. So then I'm taking that money, and basically the way that it works, Kerry, is your money never leaves that account, but you can collateralize it with the insurance company. So they'll give you up to 100% of your cash value as a loan of their money, right? So now you have other people's money, you have use and control of that money, and you're going to go buy an asset that's going to generate cash flow back to you. And let's just say we're going to use it for real estate. Well, then I have all kinds of options. I could accelerate the depreciation. I'm going to have write-offs. So all of that money coming back to me is not all taxable. The interest that I pay the insurance company, because again, it's their money, is deductible. Now, I'm not giving you tax advice, but I'm telling you that's what our CPAs and CPAs of lots of our clients have said. It's deductible. And so, Kerry, think about it. Your money's growing and you're not paying any tax on it. The money that you're paying to the insurance company to use their money, you get to deduct. There are not very many things in your life that the money you're earning, you don't pay tax on, and the money you're paying, you get to deduct.
Mm-hmm. All right, I'm sold. So do you have to go through a physical for this policy? Obviously.
Yeah. So what you go through an underwriting process, and you don't pay any money or anything, and there's no obligation. They send you through, and they'll say, based on your underwriting, or I'm sorry, your medical history, your medical condition, your overall health, and your financial health and your financial capacity, this is what policy you would qualify for. Could be standard, could be super preferred, somewhere in those ranges are normal, right? And then they might say, hey, you can put $1 million a year in, or you can only put 50 grand a year in. And then they come back, they make that offer. Then we get together with the client and decide, is that a good offer, or should we go to another insurance company and see if we can get a better offer?
All right. And so I assume usually you're looking for mutual insurance companies because they have the highest payout and you get the dividend rate. And technically the policyholders own the company. So when the company has excess profits, it's distributed to the policyholders. Do I have that right?
Absolutely. There are two different types of insurance companies, mutual companies and stock companies. They're required by law to distribute the profits of the company to the owners. Shareholders own stock companies and mutual companies are owned by policyholders, just like you said. So you get a guaranteed underlying return, and then you get a dividend paid on top of that. And when you look at an illustration from a whole life company with or a whole life policy with a mutual insurance company, you'll see two columns. One is the guarantee, and the second one is the current market conditions. Okay. If you look at a universal life policy, it's a projection. It's not guaranteed, nor is it what's actually happening now.
Gotcha. So you have to be wary of these because, universal, I guess, is dependent upon market conditions. So you could have a potentially higher payout, but you could also get a lower payout, right?
Potential. That's right. So exactly. And what they do is they show you this return, Kerry, every single year. And we know that it's not going to be every single year because if it's tied to an index or it's tied to a sub account that's similar to a mutual fund, we know those accounts are up and down. They're not just consistently growing.
Right. So subject to market conditions. So that's a key differential between the two. So, all right. And what other benefits do we have for these policies?
Well, I mean, obviously at some point in time, when you graduate from this world, there's going to be a death benefit passed on tax-free, but it's really three things. You have the policy, which is your money pool. You have the assets that you're buying, whether it's real estate, businesses, franchises, storage, all of these different things. And we advocate that, either buy what you know, right? And you can educate yourself on anything, or find somebody who's syndicating that you trust, that that you like their strategy, and or buy a franchise that somebody else has proven this concept and you're going to go out and repeat it. And, when we look at what's going on in this world, the benefits are we're buying assets that keep up with inflation, right? So they grow and you can raise rents or prices if you need to keep up with inflation, but they appreciate in value. So you have a rate of return there. They generate cash flow. So you have a rate of cash flow. Then you have a rate of return of the growth inside the insurance contract, and you get all of that. Normally, Kerry, you'd have money sitting in a money pool, like in a checking account or a mutual fund or something, and you wanted to go buy an asset. So you either have that money in that account or the asset. Here you get both because I can collateralize that 100%.
Right.
I get both.
Gotcha. All right. Makes total sense. So effectively, you can collateralize a loan with the cash value of your life insurance policy.
Right. And it doesn't affect the performance of the insurance policy. You don't apply for the loan. Mm-hmm. They can't ask you what you're going to use it for. You don't have to pay it back. We recommend that you pay it back and you use this as a money pool, that money flowing in and flowing out, creating, velocity of money by using the money over and over and over again, just like the bank would do. But you're in control. And one of the things that we like to say, Kerry, is whoever controls the money makes the money.
Yeah, this is true. Very true. So, all right, people want to find out more, Jim, about what it is you're doing and how they can benefit from this. What's the best way to find you?
Yeah, CreateTailwind.com. So it's one word, CreateTailwind and .com. The reason it's CreateTailwind is most people are fighting a financial headwind, and we can show you how to turn that headwind into a tailwind. And the other way that they can find us is on YouTube. It's just CreateTailwind, all one word. There's a bunch of videos that break down this concept from the basics to more advanced videos. And then we have a podcast that's called Breakaway Wealth, that we talk about how people are using this concept. Have a lot of clients on just talking about how they've built their system, what assets they've bought, how long it's taken to build their system, et cetera. So more kind of practical day-to-day real life examples.
All right. And if you got a question for Jim, please feel free to send us an email, kl@kerrylutz.com. And of course, sign up for our free newsletter, financialsurvivalnetwork.com. Jim, very enlightening. Sounds like it has a lot of good uses, and we'll look forward to speaking with you again.
Sounds great. Thanks for having me on, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.